Dell reported a record Q1 fiscal 2027, and the stock moved 30% in a single session, a reaction that demands explanation before it invites celebration. The revenue guidance for the full year came in at $165 to $169 billion, against a consensus of $143 billion, and Q2 guidance of $44 to $45 billion stood 25% above the street's $35 billion estimate. That gap is not a rounding error. It signals that analyst models for enterprise AI server demand were structurally low. Yet the detail that most repositioning pressure concentrates on is what Jeff Clark said next. Component supply, not customer demand, is the constraint on further growth. The distinction matters because a demand-constraint business is bounded by customer budgets and deployment timelines, while a supply-constraint business is bounded by the production capacity of a handful of upstream manufacturers. Institutional buyers who moved into Dell on the beat are pricing a demand story. The supply constraint language introduces a different thesis, one where Dell can sell everything it can build, but building faster depends on parties outside Dell's control. Capital that entered on the earnings print has implicitly accepted that distinction, whether or not it has been explicitly analyzed. The 30% move itself is not fully explained by the beat alone. The magnitude reflects a prior positioning underweight across AI hardware names relative to the actual enterprise deployment curve. Retail and momentum flows absorbed the gap between analyst estimates and the real order book on the same day institutional positioning adjusted. That convergence is what produced the magnitude. What the move does not resolve is whether the supply constraint is a temporary component allocation lag or a structural ceiling on how fast Dell can expand its AI server capacity, because the answer determines whether the guidance upgrade is a floor or a peak.
Dell's supply constraint lands on a specific upstream problem that the earnings call named but could not solve. High bandwidth memory has become the choke point in the AI hardware buildout, because NVIDIA's Blackwell accelerators depend on stacked DRAM modules that only 3 companies can produce at scale, and reported order books for those modules stretch past 2027. The capital implication of that timeline is direct. Dell's ability to execute on its own guidance depends on allocation decisions made by a 3-firm oligopoly, and those allocations are not disclosed in Dell's filing. ETF flows into AI supply chain names have begun to concentrate on this layer, not on the final server assembler, but on the memory stack that the assembler cannot substitute. That repositioning reflects a reading of the supply chain that treats the HBM bottleneck as a persistent constraint rather than a cycle lag, and it is a different frame than the one the Dell move was priced on. The tension between these two capital frames, one pricing Dell's demand visibility, one pricing the memory layer supply scarcity, is where the next repricing lives. If institutional allocation has already moved toward the HBM layer and away from the assembler tier, then the Dell move may already have transferred the marginal upstream. The verification for this is not an earnings print, but an allocation decision, whether the 3 HBM producers expand capacity commitments in the next 2 quarters or hold the order book ceiling where it is. That decision is what the 30% Dell move cannot price on its own, because it belongs to a different company's production planning cycle.
The same day Dell's supply constraint entered the conversation, oil edged lower on a tentative US-Iran 60-day ceasefire extension, with a deal reportedly reached but pending Trump's approval. The Strait of Hormuz, which carries roughly 20% of global oil trade, had carried an open-ended disruption premium since the conflict intensified. A 60-day extension removes the immediate physical supply risk from energy pricing, and the market read it as a risk-off removal rather than a risk-on signal. Treasuries gained alongside equities, which is the signature of a risk premium compression trade rather than a growth re-rating. The relevance to the AI infrastructure frame is indirect but real. Energy cost is a primary operating expense for hyperscale data centers, and oil staying lower removes one variable from the CapEx cost model that data center operators use to evaluate AI server deployment economics. Foreign institutional flows into U.S. equities on Thursday included both the earnings re-rating in hardware names and the oil risk removal in the cost structure, 2 separate inputs converging into the same broad market advance. The open question is whether the 60-day window produces a durable agreement or expires into renewed disruption, and that distinction affects the forward cost model for AI infrastructure deployment more than it affects the near-term stock price. Dell's guidance is already set. What the Iran deal status affects is the economics of the customers ordering AI servers, the hyperscalers whose data center expansion decisions are the demand signal behind Dell's own order book. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.